there's a lot of lessons from today's price action, and I want to try to be able to get through all of them so that you guys can all learn. Hey everyone, check out this recent afternoon meeting where I got into a discussion on MOCs, market on close orders, and the importance that they have to the market. Let's check it out. One thing that we do need to still talk about though is MOCs. Market on close orders, what they are, why they're important, because we're getting this information in the virtual trading floor, and a lot of people had questions on it. Maybe you're not used to seeing that information. Okay, so you've got these order types that you can put into the market. Market on open orders and market on close orders. We're specifically talking about market on close orders. And market on close orders create a market on close imbalance. And that's the number that we're looking at. So the early numbers for MOCs, because we're able to get those numbers fairly early. I think, Pat, what time did you first post that? Like 3 o'clock or something? Might even been before that. We were looking at 1.4 billion to sell. And when 350 came around, it was over $1 billion to buy. I think it was 1.1 billion to buy. That's a huge flip. I find generally that anything that is in excess of $1 billion to buy or sell is market moving. Early look usually starts around 2 p.m. for the NYSE, says Pat. So I tend to find anything that's in excess of $1 billion to be market moving, and especially when you get that big of a flip, 1.4 billion to sell to over $1 billion to buy. That's a huge number. That's going to have an impact on the market. So it's something that we're paying attention to. And what an MOC order is, I was trying to explain it on the radio. I'll re-explain it now, back when the market was open. So there are a lot of funds out there, a lot of hedge funds, a lot of mutual funds, pension funds, who need to own or sell the price of the close. Right, so the price of the close on the SPY today was 434.04, right? $434.04. So there's a lot of funds out there who they need to have that price marked for their books, the actual closing price. So what they do is they put into the market a market on close buy or a market on close sell order. So maybe I'm a fund manager and maybe Pat is a fund manager. Let's just create a simple example. I am, for the Derrick fund, I need to buy 100,000 shares of Apple at the closing price. So I'm going to put in a buy order, 100,000 shares Apple, market on close. Give me the closing price. I don't care what the closing price is. I need that price. Maybe the Pat fund, for whatever reason, he needs to sell 50,000 shares of Apple at the close. So he's going to put in an MOC sell order, market on close sell order, to get the closing price for 50,000 shares. Well, I'm there to buy 100,000 shares. Pat is there to sell 100,000 shares. That creates an imbalance of positive 50,000 shares. So when we're looking at these MOC numbers that Pat's getting into the VTF for us really early on, and then they officially hit at 350, it's the total amount. So market wide, we were looking at 1.4 billion to sell, and then that flipped to 1.1, I think, billion to buy at 350 when the number actually came out. And again, I find anything to be in excess of $1 billion to be market moving. So the market's expecting, and then what happens is the market begins to price it in. And there's algorithms that do this. I personally know people. There are people even here at T3 who have algorithms that are designed to take advantage of MOCs. So when they see that there's a buy imbalance, let's just say, of MOCs, there are more market on close buy orders than sell orders, their algorithm computes the math and says, okay, in order for these MOCs to be fulfilled, this buy imbalance, it's supply and demand, right? So a higher price creates more selling, and that can satisfy and eventually by the close, that imbalance needs to be evened out to zero. So they even out the MOCs to zero on the closing print. That is why the biggest volume bars of the day are almost always the opening volume bar and the closing volume bar, because they have to settle the MOCs for the market. So the algorithms come in, all right, the algorithms think it's going to be 1.4 billion to sell. So they're driving the market down to make up for that. And then, oh my God, it's 1.1 billion to buy. Boom, flip. And that drives the market all the way up. So that's why we pay attention to that.